Hi, this is StrategyCast, where smart marketers and bold business thinkers share the plays behind brand breakthroughs. I'm Lori Jones, President and CEO of Avasec Communications. What if the biggest thing holding marketers back isn't creativity, campaigns, or technology, but financial literacy? Today, we're digging into one of the most overlooked strategic skills in marketing, understanding the numbers that actually drive business decisions. We'll break down why marketers must understand unit economics, how to translate marketing performance into the language of the CFO, and which metrics truly matter when you're proving marketing's impact on revenue and growth. My guest today is Kathleen Booth. She spent her career helping companies scale through smarter marketing strategy and has deep experience working with leadership teams and boards where financial accountability drives every decision.
A competitive edge starts with strategy, and strategy starts with knowing how to develop one. StrategyCast is a leading marketing podcast that serves up strategic insights, trends, and tips to help separate your business from the pack. Tune in weekly as host Lori Jones interviews bold marketing leaders who have priceless wisdom and are willing to share. Each episode explores cutting-edge approaches that have proven instrumental in transforming brands into industry trailblazers.
Welcome to the show, Kathleen.
Thanks, Lori. I'm excited to be here. Thanks for having me.
Oh my gosh, I am so excited to dig into this. This is one of those evolving topics that we always need to, just uncover and completely start over in a lot of situations. And some of our guests today may not have even heard the sort of things that we're going to be discussing. The most important impact that I think that we can make today is really helping marketers be smarter at the boardroom. And that's what we're going to dive into. Before we get there, tell us a little bit more about your background and why you love numbers so much.
Yeah. Well, I'm happy to dig into that. And my background's a little different. I am today a VP of marketing. I've been a CMO, but I didn't come up through marketing through one clean ladder. I've been an operator, a founder, an agency owner, and now I run marketing at a venture-backed startup. And that mix of experiences has really shaped how I think. So I would say running my own agency was probably the inflection point for me.
Right.
When you are responsible for your own P&L, you stop caring about leads pretty quickly and you start caring about cash and margins and how long it takes you to get paid and for you to be able to pay your employees. And that responsibility really rewires you as a person. And, it causes you to value different things, I think. And I would say later now that I'm working inside venture-backed companies, I'm seeing the other side, which is that boards don't ask about individual campaigns in marketing. They ask about growth efficiency and payback and whether your pipeline is actually converting. And so that shift for me wasn't really theoretical. It was literally sitting in rooms where the CFO was talking about burn and runway and realizing marketing either participates in that conversation or gets totally sidelined.
Well, and I think one of the specific examples is really understanding the P&L, right? Why is that such a critical skill today?
Yeah, it's interesting because I did study marketing, just to be clear. Like I have an MBA in marketing.
You are very, very good at what you do. Yeah.
Well, it's funny because I was a political science major, so I have this very strange background.
Yeah.
But I went to graduate school. I got an MBA in marketing, so I'm classically trained. But I would say, looking at and introspectively at the profession of marketing, most marketers who come up through a marketing pathway tend not to understand the P&L because they've never had to own it. Right. They inherit dashboards full of marketing metrics, and then they assume that that's the job, right? Like click rate, conversion rate, leads, MQLs, demos, and those are all important things, and they're great leading indicators. But the problem is that those metrics are upstream, and so the business actually runs on revenue and margin and cash. And if you can't connect the work you're doing in marketing to those things, then you are fundamentally speaking a different language than the rest of the executive team. And that's really where the friction for marketers shows up. marketing comes into the board meeting or into an executive team meeting and says, we drove 5,000 leads. And the CFO is thinking, that's
Oh, what?
that's great, but our cost of customer acquisition just went up and none of those leads closed. And the thing that's so crazy is like both of those things are technically correct, but they are not aligned on what really matters. And so I've seen it play out in board meetings where marketing presents activity, the CEO reframes everything in terms of pipeline quality and conversion. And if you're not already as a marketer doing that translation yourself, you lose credibility like in real time as that's happening.
So why is it happening so much though? Even with a lot of the clients that we work with, quite often the marketing counterpart will say, this is what we're interested in. And we're really pushing the impact ROI side of things. Do you think that there's just too much infighting between sales and marketing? And, or is it cultural? A lot of organizations want to keep marketing out of finance. What is the real issue here?
Yeah, I think there's probably a couple of different things at play. In my experience, it's a combination of things. One, there are definitely situations where marketers don't present the numbers intentionally because they don't tell the story that they want to tell, right? Like you are getting your 5,000 leads, but they're not converting.
Right.
And so I think there's like this fear that marketers have that if I walk in and I am honest about this, I'm going to get fired. And unfortunately, like that is the opposite instinct that you should have, because when a board is hiring a marketing leader, they're not hiring somebody to just tell them what they want to hear. They know that there's going to, excuse me, I have allergies, so I'm choking through all this.
We were talking about allergies pre-show. We were both feeling not well today, but we're going to power through this.
Yes, I'm froggy, but I will get my point across. So I think they know that not everything's going to be perfect all the time. What they want isn't someone who's going to come in and say, hey, we're firing on all cylinders, we're hitting all the numbers. They want someone who's going to come in and give a sober assessment of where performance is and to be honest and say, here's what's not working.
Right.
And then to follow that with, here's what we're doing about it. So that's number one, is like marketers that intentionally obscure the information and don't talk about it because they don't like what it has to say. I think number two is there are also situations where marketers don't always have access to the right data. And this is where I think you have to build a really strong relationship with your CFO, because to do the job well, you really need access to customer acquisition cost data, to lifetime value. You should be getting at the end of every month when the books close, you should be getting like a monthly P&L that has all of the money that marketing spent and reconciling that against what your budget is. Did you go over? Were you under? Based on that spend, how are your different channels performing? Like you need that data in order to be able to walk into that room and be fully informed and to be able to give the same answer the CFO is giving, because you have to be on the same page. Nothing ruins credibility more than like, as the marketing leader, you give one answer and then the CFO is like, that's not exactly right. So I think there's a couple of different things at play. But ultimately, like ownership for fixing that, like rests with you as the marketer. You have to take the bull by the horns and get those answers and be willing to be honest about them.
And what advice do you have for our listeners today who are not getting, there are a lot of financial teams. I think if there's a CRO at the table, this is not the case. But there are a lot of finance teams that just are not giving marketing and sales, quite frankly, not only the right data, but data at all regarding revenue.
I mean, I think that's so dysfunctional.
It's archaic, but it's happening.
It's dysfunctional. And so you have a choice to make, right? You either need to go to battle and get that information and figure out a way to persuade the company that it's important for you to have it. And some of that has to do with understanding why it's important to have that data and being able to say, here's what I'm going to do with this information and why the company should want me to have it.
Right.
And so you either need to be able to go to battle and get it, or you have to like, your other choice is either make your peace and accept that you're never going to get it and live in that constraint or find another job, because
move on.
I would argue that like you cannot do the job well without that data. And what's risky about it is like when you then go to do your next job, they're going to ask you for this information. They're going to say like, tell me how you performed. And they're not going to want to hear, I got 5,000 leads. They're going to want to hear, this is what the ROI was. Here's what the CAC payback period was. And if your answer is, well, nobody gave me that information, it makes you look JV and disempowered. And so there's that risk too.
Yeah. No, I could not agree more. Something that I think is difficult here for all teams is the awareness, top of funnel side of everything, really measuring brand health when it comes to top of funnel metrics. And it just reinstills the importance of having the top line revenue insights along with that. But how generally, we've talked a lot about the specific metrics that happen through the funnel outside of true brand health. So it's a brand new company. They're launching for the first time. They got an 18-month sales cycle. It's going to take time to build awareness. What are you looking at in those situations early on to still help tell a good financial story?
I think, there's a certain core set of unit economics that should never change, right? Whether you're early stage or late stage. And unit economics are really just the math of how you make money per customer. That is it. But it really changes everything. And so the core ones that I pay attention to are CAC, which is cost to acquire a customer or customer acquisition cost. And not just blended CAC across everything, but CAC by channel and segment. And that tells us where we're actually efficient, which channels are performing well and we should invest more in, which segments, customer segments, are profitable for us and where we should double down. That's a really important one. Another really important one is payback period. How long does it take to recover that customer acquisition cost? So if we spend, $1,500 to acquire a customer, how long does it take for us to get that money back and start turning a profit? That's what your CFO really cares about because it ties directly to the cash coming into the business.
Right.
Another one is lifetime value of customers, and more importantly, what is driving lifetime value? So retention, expansion, product usage. And then I would say conversion rates across the funnel, demo to opportunity, opportunity to closed won. That's where marketing and sales really can move the needle. So at Sequel, we're constantly looking at things like if we book X number of demos from an event that our team attends, how many of those demos become opportunities? How many of those opportunities actually close? And what's the average contract value? And that's the difference between saying like this event was a success because we met with 50 people and 20 of them requested a demo, and being able to say this event produced this exact amount of expected revenue. Like that's the key difference. And so these numbers that we're talking about, they're important because when used properly, they should dictate decisions in the company. So if your CAC payback period is too long, you can't scale your spend. And if your CAC is rising in a particular channel, you either have to fix it or cut it.
Yeah.
And so product launches and pricing and even hiring decisions all need to trace back to this fundamental unit economics math. And that is no different at early stage companies versus late stage companies.
I love it. And I think it's so smart. How do you take a look at client retention as a part of that as well? So let's say top of funnel awareness is really implementing incredible awareness and or campaigns and messaging that really helps the current clientele feel as though they've made the right decision in choosing client A. They are able to prove that the retention rate is increasing through the awareness that's in the marketplace and the thought leadership and the pride that's built through all that. How do you then measure that sort of thing?
Yeah, I think there's two other really, really important metrics that companies are looking much more closely at now than they did maybe a few years ago. And that is GRR and NRR. And so these are two important ones to understand. So GRR is gross revenue retention, and that measures the percentage of recurring revenue retained from existing customers. And it doesn't include expansion, okay? So 100% is the highest number you can get with GRR. That is how many of our existing contracts are going to renew at the same price that we have them today. Then, and like that's a baseline measure of, churn or retention. Then you have what I would argue is probably a more important number, and that is net revenue retention. And that includes expansion revenue, which is like upsells and cross sells. And so it can be higher than 100%. And in fact, you probably want it to be higher than 100%. So GRR indicates product stickiness, and marketing can impact that, right? Like there's customer
Right.
marketing, there's product marketing, and NRR indicates overall growth, where marketing can also play a role because we're helping get the word out about additional expansion opportunities. We're looking for signs of product qualified leads and helping to market them and nurture them. And I think that combination of GRR and NRR is really important for the health of any kind of a recurring revenue business. And marketing has a really important role to play in both.
Yeah, they do. How often do you see a financial dashboard out there that actually includes all of this?
I mean, I would say more often than you would think, because, and part of that is because I um I do work in venture-backed companies, and these are metrics that venture capital investors want to see. They expect to
Right.
see it in the board meetings. And so usually the CEOs I work for are very attuned to this. They're reporting it out, monthly, weekly, quarterly, et cetera. I think it should be a regular conversation with the whole company because these are metrics that everybody can impact. When we're talking about product stickiness, that's everyone's job, right? It's making the customer happy, it's getting them to use the product, et cetera.
I think one of the most difficult questions that we as an agency, and certainly you get asked, even, in your CMO or VP roles, it doesn't matter. It's just how much the spend should be. And in a lot of early stage companies, we're basing that suggestion based on what the revenue goal is. There isn't revenue yet. This is where we ultimately want to go. In existing companies, based on the maturity of the brand, it can be a lower percentage. It's software companies, they typically start at 10% no matter what. What advice do you have for our listeners today on how exactly to establish the right budget?
Yeah, I think it's less like I'm not a big fan of like marketing should spend X% of revenue. I just think that's kind of an arbitrary percentage. And also, like, I'll give you an example. If you have a paid ads campaign that's just working incredibly well, why would you cap it at 10% of revenue? Because
Right.
in a campaign like that, every incremental dollar you spend is generating more dollars. So like it's a kind of a lazy proxy. And so I think the better way to think about budgeting is looking at the LTV to CAC ratio. So lifetime value of a customer to what it costs to acquire that customer. Generally, and this is going to be like a super general rule of thumb, you want it to be at least 3 to 1 or higher, meaning that the customer's lifetime value, what they spend with you over the whole time they're a customer, is at least 3 times what it costs you to acquire them. And that indicates kind of a baseline of healthy profitability and sustainable growth where you can generally cover your overhead costs while still scaling. So that's the baseline. I think if you're at 4 to 1 or higher, you're in a strong high growth business model. If you're at 5 to 1 or higher, you're probably under investing in marketing and you could be spending even more. So that 3 to 4 to 1 range is generally a very healthy area to be. But in order to calculate that, you need to know lifetime value and CAC, and you ideally need to know them by channel.
Yep. Very important. And I think marketers actually really confuse the two quite a bit, or
Yeah.
they dive deep enough. What's an example of a marketing program that looks successful on the surface, but it's actually not really performing financially?
I do think paid ads fall in
Yep.
this category really often, where you are spending money on your ads and you're like seeing all these leads come in and it feels so good, right? Like, oh, they're filling out our demo form. But unless you're truly measuring like downstream, how many of those turn into customers, how long do they stick around? Like that's the piece that I think a lot of marketers miss is like not just did we win them as a customer, but especially in recurring revenue businesses, it's very rare that you're going to be profitable on a customer in the first several months, sometimes not even in the first year. And so you do need to pay attention to how long that customer stays with you and what that lifetime value is. And I think with paid ads, we tend to just measure the first part, like, ooh, what's the value of a lead? How many leads did we get? And we tend to think that feels really good. But when you start to really dig in and look downstream, and you might realize, in some cases, these ads are bringing customers in, but they're only staying for a month and then they're churning. That is not a win.
Why is it then that vanity metrics still are all consuming when it comes to marketers? It's still the big discussion point of any report that they're provided or internal outcomes.
Yeah. So a lot of what used to work as, I think, proxies for marketing just doesn't anymore. And that includes things like impressions and clicks, and even like I was just giving the example of raw leads. I think the reason marketers like them is that they're very easy to measure, so they stick around. But they don't tell you if the business is actually growing in a healthy way. And so part of why they persist is organizational. Our marketing tools are built to report on them. And early in your career, as we talked about already, those are the numbers that you tend to be handed. And so the shift is really about forcing everything to go through one question, which is, did this create pipeline that converted? Anything that can't be traced to pipeline is a vanity number.
Right.
Pipeline that turns into revenue at a predictable rate, that is the holy grail. And so the industry conversation is already starting to move there. You see less talk about attribution models and more about pipeline and conversion and efficiency. And the truth is, like, as much as everybody loves good attribution, like, at the end of the day, CEOs don't really trust attribution. Like, there's always a way for them to pick it apart and find a reason that it isn't true. And they just trust revenue. And so the practical move for marketers is to rebuild your reporting and start with revenue and then work backwards and be able to tell that story of what influenced revenues, which channels are actually producing opportunities that close, and then everything else from there becomes secondary. And I would be surprised if your CEO even cares about anything else beyond that.
Well, they don't understand impressions or clicks anyways. I mean, and they don't need to. It really does not matter. I think that there's such an interesting anomaly that brings a lot of questions to the table that are difficult for marketers to answer. And again, it's the sales cycle. So if you've got an 18-month sales cycle, it's very difficult to have that conversation that you just illustrated because of the length of time needed to ultimately increase awareness and additional touch points. So in that situation, knowing that people are moving closer and closer and closer to decision making, I'm sure creates incredible amount of value. But how do you measure that? How do you measure the signals that the buyer is getting closer and closer and closer during an 18-month cycle?
Yeah, I mean, look, as much as I have a beef with the whole space of attribution, there are tools out there that can help you track all the different things that are influencing, your buyers, all the different touches you're having with them, and not just like one buyer, but everyone across a buying committee. So I do think you have to understand that, and you have to be able to know, like, almost do a regression analysis and understand what's helping. Like, what assets, what campaigns do we have that have a higher propensity to move buyers closer to decision? So that is a starting point. But some of what you're also talking about is brand, right? Like, how do we measure
important
brand?
Yeah.
And I think brand often gets treated like it's not measurable, which gives people cover to avoid being accountable. And I just don't buy that. I think you won't tie every impression to a deal, but you can measure whether brand is making your pipeline more efficient. And so, you need to look at things like, are inbound conversion rates improving? Are sales cycles shortening? Are you seeing more direct traffic, more branded search, higher win rates in competitive deals? When we launch something new at Sequel, I care about whether it shows up in pipeline quality. So are better fit accounts coming in? Are more senior buyers engaging? Do deals move faster? The mistake that a lot of marketers make is defining success in isolation, where they have brand metrics in one dashboard and pipeline in another. So I think you have to connect them, even if it's just directional. And that's okay if it's directional. You can say, like, these numbers are improving. Maybe there isn't like an absolute number that we know is a success, but if things are heading in the right direction, that's a really great thing to be able to report. And I think the more important thing, though, is really upfront, which is before you launch anything, you need to align with leadership on what success actually means. And that's the piece that a lot of marketers miss. Is this about awareness, or are we trying to improve like move win rates in enterprise deals.
Mm.
Those are very different programs, but like getting that alignment up front, documenting it, and knowing what that yardstick that you're measuring success against really is, that's going to save you a lot of heartache downstream.
Yeah, I could not agree more. The piece about brand that I think is very interesting here is the integrated component of the media types, not just digital, but PR, trade show,
Yeah.
uh, you know, direct mail, which is still very effective in a lot of very large scale B2B programs out there. What advice do you have for our listeners today on how you can connect? EMV, it seemingly is outdated, but if you have a unicorn event when a big PR component hits market and you can see that from a website standpoint with traffic, there's something to be said about that.
Oh, totally. I think there's two things that I would say here. One is that everything you do, you can and you should be tracking on an influence basis. Like you may not be able to say definitively this event was the thing that led to this outcome, but I think we can say this event influenced the outcome and here's how. We know we touched these people. We know we saw website traffic increase by this much. So tracking campaign influence is a great way to be able to communicate the value of what you're doing. And then I think the other piece of that is incrementality. And
Right.
this is something that I take from my experience working years ago in the ad tech industry, where incrementality is everything. It's how they test and measure everything. And the whole concept behind incrementality is like, let's do a test and see, with this population, what happens if we don't do thing X? And with this population, if we do, it's easy to do with ads, right? That's a very easy experiment. But the example you gave is, I think, illustrative, which is like, if we have an event and we know website traffic massively spiked at a certain moment, it's pretty easy to correlate that moment to what was happening at that given point in time, assuming you were doing something. If some other thing happened, like an influencer mentioned you or something happened in the news, like that might be a little more difficult to measure or to find, but generally we can track these spikes back to something.
Yeah.
And so that is another example of incrementality. And I think that's a very viable way of communicating impact.
Yeah, I love that. For our marketers today, where are you getting most of your information? How are you staying up to speed with what's happening? What are you reading? What are you listening to? What is your go-to source?
Oh gosh. I really rely on my peer network quite a bit. Before my current role at SQL, I was VP of marketing at Pavilion, which is a really large global community of go-to-market executives. And that was an incredibly transformative experience for me. There's 10,000 members around the world. They're from some of the most amazing companies. I learned so much from my peers there and from some of the structured coursework there. And I think it helped me build my network. And now, the relationships I've built through that have really stood me in good stead. I also do tend to follow certain venture capitalists because I think they're kind of at the forefront. So a few people I would mention, they happen to be women. But Cassie Young at Primary Venture Partners puts out amazing content. She's so smart. Liz Christo at Stage 2 Capital is another one. Those are just a few of the people that I think are putting out really great content and that I love learning from.
I love that. Thank you for that. As we close in at the end of our show today, I've got one final question for you. What's the biggest misconception marketers have about their role in driving business performance?
Oh, I think by far it is that marketers assume that their job is to drive activity, whereas sales job is to drive revenue. And that is just not how modern go-to-market works. Marketing owns a huge portion of pipeline creation and quality. And if you're not accountable for revenue outcomes as a marketer, someone else is going to step in and take that ownership. And so the moment the perception changes is when you stop reporting what you did, the activity, and you start explaining what it produced in business terms. And so when you can sit with the CFO and say, this program generated pipeline with a 40% close rate at this CAC with this payback, and here's why we should scale it. That's when you're no longer the person running campaigns. You are helping to decide how the company grows. And I think that's it right there.
Explanation point. Boom. That's awesome. I love it. Kathleen Booth, what a pleasure today having you on the show. What's the best way for our audience to get in contact with you?
Yeah, you can find me on LinkedIn, mention that you saw me here, or you can follow me on my Substack, which is codemeetscreed.substack.com. I publish a newsletter weekly with how I'm balancing AI and brand to grow the company.
That sounds like a great next topic to have on strategy. We might have you again on at the end of the year. And to get in contact with me, please visit LinkedIn as well, Lori Sartorius Jones. Kathleen Booth, it's been an absolute pleasure. Thank you so much for your appearance on StrategyCast.
Thanks for having me.
That's a wrap. Thanks for joining us on today's show. We hope your strategic brains are spinning with new ideas and bold inspiration that will elevate your strategies and marketing know-how.